As rates have started to decline, we all want to know, will the housing inventory now come back? We know the home buyers, they're waiting for better prices and also lower interest rates. The sellers, they're waiting for the end of the lock in effect. What is that? When homeowners are reluctant to sell their current house that they purchased with low interest rates because now they'd be forced to buy a house with new higher rates. But as interest rates and mortgage rates are on the decline, maybe home sellers are more likely to sell because now rates aren't that high. We have the data to show exactly when that threshold might be met. Today's 30-year mortgage interest rates fall to 5.99%. That's the lowest rate we've seen in quite a while, now just a hair below 6% as well. Now we can see here in purple, that's the average mortgage rate, and in green, those are new home sales. We know that interest rates have not been this low. The mortgage rates specifically have not been this low for quite a long time now. Now, the green bars show us the number of sales that took place. And this is 30 years of data. We wanted to look at 30 years of data because the average or the typical home loan is 30 years, and we want to see how many homes were sold under every bracket of mortgage rates. So, for example, and this is going back over the 30 years, we can see the vast majority of the mortgages that were taken out over the past 30 years were taken out at a 6% mortgage. We're right around 6% right now. So that's pretty interesting that if rates decline, the average homeowner over the past 30 years, well, they have their mortgage right around here. So it's more advantageous for them to sell if mortgage rates are in the decline. But that's not very realistic. A lot of things have happened over the past 30 years. Let's consider just the past, more recent era, since the last financial crisis in 2008. That's when most of us probably bought homes, since 2008. Well, specifically, we know, first of all, we're right now to 6% mortgage rates. And at 6%, 6 to 6.5%, there's been approximately 7.1 million homes that were sold, but we can see there's a real glut. The highest number of homes that were sold when mortgage rates were between 3.5 to around 4.5% mortgage rates. So clearly, with mortgage rates now at 6%, if someone were to sell, they probably most likely bought their house when the mortgages were around 3.5 to 4.5%. So with rates now at 6%, if they were to sell their 3.5% mortgaged home and then buy a new home, their interest rates go up. That, in essence, is a lock-in effect. They don't want to sell their home until the current rates are close, or at least closer, to where they bought their first home at. Now, again, here graphically, we can see exactly what we're talking about. The average home mortgage that we see since 2008 has a mortgage around 3.5 to 4%. And again, we compiled this data very simply. We took a look at all the new home sales and we plotted that according to the mortgage rates at that time when those homes were sold. Now, of course, some of us pay off the mortgages early. Some of us refinance. This is making some assumptions, but generally speaking, most of the homes out there on the market right now with the sellers that may want to sell, their mortgages are lower, around the 3.5 to 4.5%. Now we're talking about mortgage rates, but we're not talking about Fed funds. The Federal Reserve just lowered interest rates. Of course, they all kind of move together, but mortgage rates are different than Fed funds. In purple, that's the average 30-year mortgage. In green, that's the Federal Reserve interest rates. And we can see, of course, the 30-year mortgage is always above the Fed funds rates. By how much? Well, that varies. The white histogram bars here show us the 30-year mortgage Fed fund spread. It's very simply the 30-year mortgage minus Fed funds. That does vary. I can tell you over time, over the past 30 years to be specific, the spread is roughly around 3%, meaning the 30-year mortgage is about 3% higher than Fed funds. Now, that does vary. Currently, that's not the case. We only have about a 1.5% difference between the two. There's a lot of variables: the strength of the economy, the buying and selling pressure of the mortgage backed security market. There's a lot to be taken into consideration. Also, what's happening in the bond market, too. So we use generalities. But overall, we can see as Federal Reserve interest rates continue to decline over time, we would anticipate 30-year mortgages will also decline. To what point? Again, we see 3.5 to 4%, 4.5%. That's where most current mortgages were taken out at. And just to recap here, in green, these again are the new home sales and the 30-year mortgage in purple. And the average interest rate right now is around 6%, but we haven't seen 6% mortgages before. Most recently, we haven't seen those in quite a while. So we really have to wait for mortgages to come down quite a bit in order to shake out that inventory. Of course, this is all dependent on other factors within the economy as well. For example, if the jobs market really kind of falls apart, if the housing market starts to go down for other reasons, there may be more incentive to sell, and that could accelerate the trend. But just keep that 3.5 to 4.5% bracket in mind. We hope this has been helpful. We look forward to seeing you back soon.